Donald Trump has been added to the Reserve Bank's list of concerns as it works to keep the economy on an even keel. Governor Philip Lowe says the protectionist trend is a major threat to Australia. In a speech to CEDA, the governor also raised concerns about an internal threat, rising household debt, calling on Australians to build up their savings as a buffer. But the latest very weak wages numbers suggest that will be extremely hard to do. Here's finance correspondent Philip Lasker.
Australia's glass-half-full Reserve Bank Governor Philip Lowe is losing sleep. He's losing sleep over Donald Trump's protectionist approach.
Of the things that I worry about, that's probably right at the top of the list. And you can see in country after country there's a political movement away from support for open trade in goods and services and open movement of capital. And I think that's dangerous for the world, and it's particularly dangerous for us.
The governor points out that for 200 years, Australia's growth and prosperity has been built on selling resources to the world and importing capital. Among the major internal risks highlighted by the governor was the build-up in household debt. Falling interest rates and the run-up in property prices has seen household debt accelerate much faster than other comparable countries. And that has the credit ratings agencies worried.
The credit risk in Australia is manageable, but it's more the rate of increase that's causing us concern. And at the same time, with this increase in the debt levels, that of course the level itself is becoming a bit of a concern.
Since taking the top job, Philip Lowe is building a case against further interest rate cuts, saying economic prospects are quite good, commodity prices have picked up, and inflation is more likely to rise than fall. Australia's runaway big city property market is also emerging as a cornerstone of that argument.
It surely must be the case that the higher is the debt, the greater is the risk. Given this, as I said recently when explaining our monetary policy decisions this year, it is unlikely to be in the public interest to encourage a noticeable rise in household borrowing, even if doing so might encourage slightly faster household consumption growth in the short term.
The level of household debt is always a matter of concern. I'd have to say, though, the service, because of the very low interest rates, serviceability is not as under pressure as it has been in earlier periods when rates were higher. But it's something for central bank governors and those who manage the sort of prudential matters for the banking sector to pay close attention to.
But there was one development which will help keep runaway debt under control. Wages growth during the September quarter was the weakest on record, up a paltry 1.9%. 4 out of 18 industry sectors are recording real wage falls over the year. It suggests households can't take on more debt, and it'll be much harder for people to pay off their debt. If the wages growth line is inverted, it usually tracks unemployment. But that relationship has been broken. It means people have jobs, but not the bargaining power to command even moderate wage increases, because they're probably underemployed and want more work. It's a threat to Philip Lowe's central scenario, which he keeps returning to, despite arguing for the need for governments and households to reduce debt as a protection from economic shocks.
I'm not doing this because I'm predicting difficult times ahead. The Reserve Bank's central scenario remains a relatively positive one for the Australian economy.
That's assuming the political and economic risks in the US, Europe and China, keeping everyone on edge, don't materialise.